Hey, everybody, before we dive in, please take a minute and check out the link you see on your screen for a message from my sponsor, The Motley Fool. It's the best way to support this work that Tyler and I are doing, and you can get the top 10 stocks to buy right now. So, there are some excellent opportunities in real estate right now. Um, I am a fan of industrial, stable offices, things like that, even though the market doesn't seem to be a fan of that right now. Um, One company that I know you're not too keen on is Stag Industrial, ticker symbol STAG. So why don't you give listeners one of your favorite alternatives and maybe tell a little bit about why we're pitching alternatives to Stag in the first place?
Yeah, I'm going to pitch an alternative. I'll kind of make the case on why not Stag right now, and it has less to do with the business and more the way they kind of finance their business, and that's hasn't exactly been to the benefit of shareholders over the last several years. Like, yes, it's a net lease industrial properties. They do a pretty good job of capital recycling, which means they buy at pretty cheap prices, sell it at better prices. They have been relatively good at maintaining a good balance sheet, and they have a relatively attractive dividend at like 4%. My one contest is that so much of its financing over the last several years has been concentrated on issuing shares, and by issuing so many shares, it hasn't been able to produce dividend growth that a lot of people would be looking for. If you look for the past 10 years, it's been less than 3%. And over the past five, so like I think, more or less after it transitioned to this monthly dividend that it pays, the dividend growth since 2017 has been less than 1%. And so if me, the investor, is looking for a return in dividends, number one, it has to clear some minimum hurdles in terms of like not yield and growth. And absent any real dividend growth in Stag Industrial, you want a high yield. But at 4.5%, that's really not that attractive, at least considering alternatives in the market today. So with this in mind, I was like, okay, if I wanted something that's not necessarily the fastest growing, maybe a pretty low growth, but I'm going to get yield or for income, a company I think that or REIT that people should be a little bit more interested right now is Easterly Government Properties. They are basically a landlord to the U.S. government. A lot of properties like FBI field offices, several for the Department of Justice, kind of the judiciary arm. They have some leases with Treasury as well, and very, very long-term leases. Perhaps slower in terms of rent escalators, somewhat right around inflation rate, and you're not going out and building a whole bunch of new properties and expecting the government to jump in them all the time, right? This is kind of it's a slow growth business. You might be able to, say, hey, we're gonna this 30-year-old FBI field office, we're gonna go build a new one. You want to take a lease on that for 20 years because the old building's, not great. They can do something like that and get a little bit of escalator there. But for the most part, it's a very, very slow growing business. But right now, you're being compensated for that. Right now, Easterly Government Properties has a yield of 10.26%. And at the same time, there is a adequate cash cushion on what they're doing right now with their payout ratio, with how much they're spending on property development, that if things were to deteriorate at all, like maybe it has to, you know, pay down some of its debts to kind of not be too exposed to interest rate changes, there's enough cash cushion there that it doesn't look like the dividend itself is going to be compromised. So again, if I'm looking just for purely income right now out of stocks that's going to, provide a good yield over what I could get with alternatives in debt or treasuries or something like that, Easterly Government Properties is something I think is a little bit more what investors should be looking for than say Stag.
Yeah, that's a really good one. I was thinking one that's kind of a little more similar in terms of property composition to Stag, and that's Prologis. Prologis, because the tower REITs have done so badly, is now actually the largest REIT in the world again. It has about $100 billion market cap. And the scale of this business is absolutely incredible. It measures its square footage in billions. A lot of REITs don't do that. 1.2 billion square feet of rentable space. It rents to 6,700 tenants, including companies like Amazon and UPS and things like that. The third quarter numbers are pretty great. Um, the only negative is occupancy was down slightly from 97.5% to 97.1%, but the rest of the numbers look fantastic. Cash year-over-year rent change on new and renewal leases was 54%. That's like if your apartment lease expired and your landlord said your rent's going up by 54%. That's unheard of good. There's just incredible demand, and these are on kind of long-term leases. So as these leases expire, let's say a tenant signs a 10-year lease, the lease gets marked to whatever the new market rental rate is, and we're seeing that rental surge from the pandemic years really being factored into renewed and new leases. So that's an all-time high. That's not going to last forever. But because these are long-term leases, a lot of the current leases Prologis has were signed, 3, 4, 5, 6, 7 or more years ago and are yet to be renewed yet. So there's a lot of room for mark-to-market increases in rent that are not totally reflected in the numbers yet. So that's the big catalyst to keep in mind going forward. Same store net operating income growth was almost 10% year over year. And because there's a lot of kind of embedded rent growth that needs to be worked through the numbers, I could see that lasting for a while, even if the industrial sector cools off a little bit. A 77% retention rate is really good when you're raising rent 54% year over year. So, um,
It's quite spectacular because you were mentioning the occupancy rates going down to 97.1. So we're still at less than a less than 3% vacancy rate. And historically speaking, industrial was actually for a long time one of the higher vacancy rate sort of industries. Industry averages for industrial were closer to like 7 to 8%. So to see that we're still in the less than 3% range in terms of vacancy is a pretty indicative sign that this rush for demand in industrial, especially where Prologis operates, is quite spectacular.
yeah, absolutely. I don't think demand is cooling off yet to the point where it's anything to be concerned about. We're not seeing the pandemic year rush anymore, where every retail sale is e-commerce and they just couldn't build the properties fast enough. Um, the other thing I love about Prologis is it's got a great cost of capital relative to its peers. In the third quarter, it issued $1.4 billion of debt at a weighted average interest rate of 3.2%. I couldn't borrow 3.2% no matter what my credit score was. I don't know about where you live, Tyler, but that's not what interest rates are over here. Um, the uh, overall average interest rate on Prologis's debt is 2.9%. That gives it a tremendous cost of capital advantage over its smaller peers. Not only is Prologis's credit rating great, but it operates in markets all over the world, including in Europe, where debt's a little cheaper. So big advantages, and no significant debt maturities till 2026, which is pretty rare in the REIT world. So its 3.5% dividend yield isn't the highest in the sector. I could see it going up very significantly as that embedded rent growth gets worked through the numbers. But you're getting what you pay for. It's a great company. There's no one's arguing that the need for logistical space is going to go down anytime soon. So it's an alternative to Stag that I think is trading at a big discount. It's down about 30% from its 52-week high, despite stellar numbers from the business. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by the Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.